And we're live. You're watching Interchain FM, and this is part of the Interchain Jam series. By the way, if you're seeking alpha in the cosmos, as usual, you don't have to look any further. I'm your host, Django and Chain. Today we are here with Mr. Jonathan Karras of Levana Protocol. We're going to talk about their new product that is currently live deployed on Osmosis and Say network, with future plans to deploy on Neutron and Injective. Welcome to the show, Jonathan.
It's nice to see you again since Paris, and thanks for having me on the show.
Yeah, absolutely. By the way, to those listening now, if you need a primer about options, perps, futures, puts, and calls, all of that, we did a first episode with Jonathan. This is the second time he's been back, or the second time he's been here. And yeah, if you need a primer, just go ahead and watch the link that is linked here in the show notes.
That must have been about a year ago now. Wow, like when did we do that? Was that maybe it was later, September
That was
last?
fall of last year, so it was almost a year now. But it's very. I'm glad you guys have made such progress and have gained such traction since then. You know, you launched your product live, and now there's millions of dollars in TVL that's currently trading on your Perps protocol. And what's nice about it is that you get to trade the Atom and Osmo market and basically anything, well, anything that's supported that's currently on Osmosis without having to do a bridge, you know, without having to, you can bridge out through IBC, so you could just do it directly there on the Osmosis L1.
Yeah, that was part of the idea, is to just be at the least amount of steps and be as close to the liquidity as possible. So that's why the first deployment on Osmosis was an obvious choice. It's really just like the largest liquidity hub within within the Cosmos ecosystem, and it is we see that partnering with a DEX allows for, especially the type of perpetual swap that we have, which is we're called. There aren't really there aren't official names for a lot of this stuff, so we call it a notional perpetual swap. You know, a lot of perpetuals like DYDX use stable coins as collateral and as part of like an insurance fund. We have a different approach, which is significantly more capital effective, capital efficient, and reduces a lot of the risks in strong market movements. And one of the ways that we accomplish that is that there's no stable coins in the system. It's essentially, if you wanted to go 10x long Bitcoin, and you were depositing, let's say, just for simplicity's sake, you're depositing a Bitcoin, which in our case would be a Axelar wrapped Bitcoin, which is the asset that is canonical or currently canonical on Osmosis. And then if you wanted 10x leverage, you'd essentially be borrowing another 9 Bitcoin so that you had exposure to 10 Bitcoin. And it has a lot of really interesting properties. And so because it's all the actual assets, it really doesn't matter how the price of Bitcoin moves. You will have certain guarantees of being able to withdraw profits without the need for a large pool of capital kind of in the background, sitting, as a as a pool to draw from. So I'm not sure how much of that analogy or explanation came across, because I'm kind of just diving into the weeds of what we do. But essentially, we've been able to, with about, our TVL is not in the millions yet. We've been out for about 6 weeks on Osmosis. We officially launched on July 16th of this year, 2023. And we've got about, I believe, 1.3 or 1.4 million of TVL, which is relatively small, but we're able to service a significantly larger portion of trade volume, especially given the trading patterns of the Osmosis, or just in general Cosmos community. And to date, we've had about $44 million of trading volume, over these last 5-6 weeks.
Trading volume in terms of daily or weekly,
No, just
monthly?
in total. If we, I
Oh,
can
total.
actually, yeah, I'll pull up. Happy to, if we want to just get into the weeds, which I think can make sense, I can show you here. If you let me know if you can see the screen.
Yes, here we are, the front end.
So if you want to see if you want to be able to just track a little bit as to what's happening with Levana, so the stats page is the best place to do that. You can start with the network, and you can see how we are the different markets on Osmosis and Say. In the past 24 hours, we've had about $2.5 million of trading volume, and in total since for the roughly 6 weeks now, just shy of $46 million of trading volume. And that's been traded by almost 1,400 different wallet addresses.
Very nice. So you did allude to the fact that this mm, this Levana mechanism is more capital efficient than if you were to use stablecoins as collateral for perps. So that would make it a different type of mechanism compared to something like Gains Network. Can
Yes.
you, yeah, can you talk about that? So, I mean, explain the trade-off space and why you think that your vision for this product makes sense this way. Because, what happens if someone imagines that using stables for trading perps is actually a better product?
So one thing that I'll mention is that we can deploy with stable support, like the math and the mechanisms do support it, albeit with a few modifications. So internally, we actually have a build that's very similar to Gains Network, which it's funny that you mentioned that, because we've never, I don't think, spoken about the comparison, but that's probably the closest to product in the market as to our stable market. Um, and so I'd put it like this, there were a few problems that we wanted to solve, and we wrote a blog post really a year ago about this, and it came from some post trauma. There was a popular Cosmos chain that we were very active in, and it collapsed, and it had an algorithmic stablecoin. And so from that kind of post trauma, one of the things that we decided was, we started thinking, well, how could you make a perpetual swap that didn't need stablecoins, that could use single-sided deposits of assets? And so one of the things that really separates us from a lot of the other perps platforms that's out there is that each one of these markets, they're really just siloed. So the Atom market, the Bitcoin market, Osmo market, and the ETH market, or the Say market, which this is our roster on Osmosis here. These are all each one of these are single pools. So you would actually come into the Atom market, and you would just deposit. And we can get into some of the risks and what exactly you're doing when you're depositing. So there's a lot of disclaimers and everything, and I highly recommend reading the fine print. We put a lot of effort into documentation, and getting into how position size collateral works. Also, if you want to just check out our audits, you want to view the source code yourself, you want to look at our robust APIs. I apologize, I'm not sharing the right screen. So we've got all of this information here. So highly recommend doing your homework. There is no such thing as risk-free yield. But to put that to the side for now, when you deposit, you only deposit one asset. So you don't have any impermanent loss. You're not, instantly selling for a basket of other goods. We wanted to be able to open up bespoke markets that really could support any crypto asset. Levana is an acronym for leverage any asset. And so the methodology that we've created is far more versatile, especially in supporting low or younger coins like altcoins. And one of the problems, as you can imagine, when you have a highly volatile asset, is that it's relatively easy to manipulate the market. If you were to think, if you were to take, for example, there's many assets that are on Cosmos which have, only $100, $100,000 of daily trading activity. Now, if an asset has $100,000 of daily trading activity, so then if you were to own $300,000 worth of that asset, or you were to just sell it instantly, you would essentially just wipe out any AMM or any order book. Assuming that the depth was consistent with what we see with a lot of assets within Cosmos, and you would cause a flash crash, which could, in many other perpetual swaps, cause cascading liquidations. You would essentially wipe out all of the long positions. And there's an attack vector where if you opened up a highly leveraged short and then you were to just wipe out the all of the longs, you could kind of rinse, wash, and repeat, and and profit. And then the inverse is true as well. And it doesn't even need to be malicious. Like, imagine if there is an asset that is that's it's a younger asset, and it is and the market is actually not collateralized by the notional asset but by a stable coin. Let's take, for example, Mars. Mars is a great example of this. Mars has I forget exactly what it is, but it bounces, I think, between a 50 to $100 million market cap. I apologize if it's higher. I haven't looked at the markets in a while. But I remember that the trading volume is relatively low, in the somewhere between $50 to $100,000 a day. So in theory, if there was a perpetual market that was backed by stablecoins that was following through a price oracle, the Mars market, then if let's say, for example, that there was a new version that was coming out, because there's Mars V2 will be coming out soon, and if everybody and their dog went long, and then the price was to rise, then it would there actually the market would become insolvent, because the way that perpetuals work is that they need to be balanced between long and shorts. So if there is consensus within the market in a certain direction that an asset is going to move, then everybody puts in a position in that direction. And then if everybody is right, then who actually pays out the earnings? If it either has to come from some type of an insurance pool, which constantly needs to be incentivized, usually through some type of inflationary token economic, non-sustainable token economic methodology, or you end up with just insolvency, which is what we saw about a year ago during the Three Arrows crash, and then again during the FTX crash, that when there was sudden legs down, a lot of these perpetual swaps, anybody that was in a short position was owed more than the totality of long positions that were liquidated, or the sum of long positions that were liquidated, or the total sum of the insurance pool. So those are some of the problems, and I know I'm kind of like jumping around a few different topics, but one of the things that we wanted to solve was that we'd be able to support younger assets without fear of insolvency, that we would be able to fully collateralize every position, and then ensure that you could still ride a wave and profit from it. But at no point would there be a bank run on the exchange where only the first that are able to close their position will be able to actually get their money out, and then the other 70% or other 50% is just going to hit insolvency because the smart contracts have been drained. So that was the pain point that we wanted to solve. And then once we started solving that, and we invented a new type of perpetual, so then a lot of other positive aspects, like around capital efficiency, single-sided staking, segregated markets, no need for an internal mark price and external index price, no concept of cascading liquidations. These benefits, which many other perpetual swaps don't have, just kind of started falling into place. And one of the ways that you can even see it, even if you aren't, reading the source code or reading our white paper, is you can even just see the capital efficiency. Like, for example, I'm opening up a long position here, and we would see something similar if I opened up a short position, and then we can see a preview of what my borrow fee will be. And then now if I lower my take profit, then you see I drastically lower my borrow fee. Because you're actually allocating less collateral to your position, because the system can now calculate what's the max gains that your position would be entitled to, based on the take profit price that you set. And obviously you can just ignore it and you could say, oh, I'll take an unlimited take profit, but you can drastically lower the cost of capital by doing something like setting a take profit. And this not only makes our perpetuals more secure than the competitors, but it also makes it cheaper for trading.
Got it. All right. It wasn't completely clear to me what exactly prevents cascading liquidations if the market goes in one way and everyone, or and let's say everyone is right, because the opposite way would be, for example, the Terra crash, and people who thought it was up only all got liquidated, but then there were a few winners emerged, like Galois and whoever, just like in the subprime mortgage crisis.
Yep.
So, but in this case, your attack vector is that of everyone is right and there's not enough money to pay out. So then,
yes, that's one aspect. So the most popular method of creating a peer to pool perpetual swap is called the constant product virtual AMM. So Perpetual Finance uses that. MCDEX uses that. I think Future Swap was the first that implemented it, probably about 3 years ago. And what the way that it works is that the imbalance between long and short will change the internal mark price. And so when a liquidation happens on one end, so then that actually impacts the internal listed price, which can then trigger a secondary liquidation, which will then again move the price in that similar direction, and then will cause another liquidation. So it's almost like you create this domino effect that occurs because of a sudden shock to the index price, which is the actual price, of a blended basket of different exchanges. So yes, I agree with your your analysis there, which is that if you have a if the price actually does move in a case, like Luna going to zero, it doesn't matter the difference between an internal mark price or an external index price, the thing went to zero. But in the case where you have market manipulation and you might just cause, a one candle that moves in one direction or the other. So while many platforms would still be able to, they wouldn't become necessarily insolvent because of that. We've seen historically that the virtual AMM or constant product perpetual swaps do get this domino effect of cascading liquidations, where one liquidation impacts the internal price, which then causes a new basket of positions to become liquidated, and it just continues exacerbated beyond that single wick that might have been maliciously created externally and didn't even occur on all exchanges.
right. So this brings up the GMX GLP pool, right? Where if you don't have segregated pools, then if something bad were to happen in one market, it has pathological effects to the entire network. And it basically renders GLP depositors as the lenders of last resort.
Exactly. It's an excellent way to put it. And there's a few other problems with GLP, and I think that this is the reason why GMX is moving away from GLP in subsequent versions. But what you end up with is, first of all, it's very hard to hedge. Like if you are a liquidity provider on Levana, then you actually just pick exactly which markets that you are providing liquidity to. The rewards that you're getting are segregated to that market. So it's just based on actual market demand. It's not, there's no dead weight assets that are then, getting that you're essentially exposed to as a liquidity provider that are, that creates a level of capital efficiency. So like you can see that, the Bitcoin market is earning here, these fluctuate, but it's earning a little bit above 70% APR. The Atom market is earning above 50% APR. And so these are, there's no need to blend this. The rewards and the risks can be completely segregated. If one, if Osmo or if ETH or if Say or any of these had some type of existential crisis, and then the price moved similar to what we saw with Luna, so the rest of the system would just keep on ticking and would be completely unaffected. So having these high gardened walls to be able to ensure that each liquidity provider could take on the risk reward profile that was applicable or relevant to them was far more favorable than having a blended basket of half stable coins and half a bunch of assets. And it also allows for us to be far more adventurous, because if there's like a new Pepe or Doge or Shiba or just even even if it's not a meme coin, even if it's just a new like Passage is launching soon. So it's what's the likelihood that you're going to see on DYDX or GMX or any of these larger platforms that inherently have contagion risk between one market and another be able to support something like Passage? It's very unlikely, because every asset that they add has an impact on their existing LPs and on the risk reward profile of the entire ecosystem. By segregating each of the markets, the we can be far more adventurous in which assets that we support, and ultimately, the vision here is to make it permissionless. So just like with Uniswap, somebody will be able to come in and just open up their new market. Nobody's succeeded at building a permissionless perpetual swap platform. And while I don't think that we're there in terms of like PIDs from automating risk aspects, because there are a lot of levers that need to be adjusted in successfully launching a market. Like, what's the sensitivity around delta neutrality? What's the sensitivity around funding rates? What's the sensitivity around, and you can see some of these when we go into like the pool structure, like, these, the, like here, like pool utilization, target utilization, the ratio between the LP tokens and the underlying collateral. Like these are all various elements that need some forethought, but the hope is to be able to automate this so that when you go to deposit a new market, the system can really scan how things are trading unlike the Osmosis DEX, how things are trading based on feeds from Coin Market Cap or from CoinGecko and other places that can bring in a lot of data from a wide variety of trading venues, and then automate a lot of these decisions, which currently are essentially manual.
Mm-hmm. Yes. So can you break down what those manual decisions look like for pricing stuff? Like,
Sure. So there's a few different things, and I might miss some, but we have all of this in the docs. What you have is first there's the minimum trade fee, So that prevents an attack vector of quickly opening and closing positions, or there's trying to just like front run the oracle. There needs to be some type of cost of opening and closing positions, even though relatively speaking that's a very minute portion of of the fee structure. There's also the funding rate, so how sensitive the funding rate is. In this case, you can see the funding rate is negative for shorts, which means shorts are getting paid, and it is long. It's positive for longs, which means that longs are paying to shorts. And if you
Right. And just because right now atom price is relatively low compared to historical equilibrium, so it's more expensive because there's more demand, right?
Yeah, exactly. So let's pull this up just to look, specifically here. So we can see that longs are paying 42% APR, shorts are receiving 66%. So there actually is a nice basis trade here. If you're a little adventurous, and we wrote, we co-authored with Stride actually um, a a document that outlines a trading strategy, which is called cash and carry, which is very popular in TradeFi, where you might want to open up a short position on Levana. Let's say you open up a short position, and we can actually see what the size would be. So you see the difference here is that long is at 720 and short is at 466,000. So there's room here, I'd say, for between about 100 grand. So let's say that you put in $10,000 worth of Atom as a short, and you did 10x leverage on that. So that would be give you the the notional leverage exposure of negative $100,000 worth of Atom, and then you were to buy a liquid stake derivative of $100,000 of Atom. So now on Levana, you're booking negative 100, and on Stride you're booking positive 100. So you're essentially market neutral to the price movement of Atom, but at the same time, you're getting paid 20% by Stride, you're getting paid roughly 60% by Levana. It's a pretty lucrative strategy that doesn't expose you to the direct volatility of the underlying. So these are some of the interesting kind of more complicated trading strategies that can be produced here. And part of what needs, to go back to answer your question, part of what needs to be configured when the markets are launched is how sensitive is the funding rate. What exactly are both the delta neutrality fees, which are kind of like one-time funding rates for opening and closing positions, and then the ongoing hourly funding rates. What is the borrow fee, and what's the borrow fee structure? What's the minimum borrow fee, and then how quickly does that leg up based on utilization? So you can see right now the current pool with there is, what do we have in terms of the the uh, total fees collected, long, short. Sorry, we got too many stats. Here we go. There's about $1 million of Atom deposited into the system here, and then of that, about 62% is currently being utilized by open positions, and so at what point does this number, the 15% borrow fee APR, which is compensating the liquidity providers, resulting in this 52% APR. So how quickly does that go up, and when it does grow, what does that curve look like? So these are the types of things that I think it's probably going to take a year or two of futzing around with the back end to really find like something that's consistent and predictable to create a positive user experience between all of the relevant parties, between the directional traders, the delta neutral traders, and the liquidity providers.
We're looking at the Atom USD market now, and the LP APR says 37%, and XLP is 52.6%. what's the difference? What's going into each of those APRs?
Sure. That's well, first of all, they're both paid out in Atom, and they're both sustainable real yield, meaning that the system is a closed loop system. The fees that are paid by traders are going to the liquidity providers, and there is two ways to be a liquidity provider. You can deposit into LP or XLP. XLP has a 45-day unbonding period, and during that unbonding period, you're still getting rewards, but you're just getting the rate, which is booked for LPs. And LPs are are able to withdraw any unutilized capital immediately, and so the premium of that liquid value is reflected in the ratio between LP and XLP, and then that is what derives the APRs. So less people are interested in taking on that risk of a 45-day unlock period. And so because there's a greater ratio of LP to XLP tokens, so then there's a direct inverse in terms of the APR that is that's captured by them. And you can actually also see that again on the dashboard by looking at the token supply. You can see that there has been minted 60,000 LP tokens and 74,000 XLP tokens, and then that is what's responsible for the divergence in the APRs for each token.
And okay, I understand, but of course, none of this is risk free. If you think that you want to deposit Atom and earn 50 upward north of 50% APR, right? Because what happens?
It's incredibly risky. All of this is very risky, and it's important not to hide the risk, but rather to effectively communicate it so that adults in jurisdictions that allow for these types of actions are able to make informed decisions.
Mm-hmm. Yeah. Have you done the math? So, if let's say a bunch of people are right and they make money from the Atom perps market by, let's say, longing from here, and then the people who are the depositors who are earning, let's say, like XLP at 52%, Atom shoots up to, I don't know, $12 in the next 7 days, and they don't unlock for another 45 days. What happens? Like what happens to their net? What do they have?
So that depends really on the delta neutrality ratio. So the delta neutrality ratio is the ratio between net open interest and the liquidity pool size. So just to read this here. So when the ratio is 0, winning and losing traders pay each other, and it's balanced. So in that case, Atom jumping to $12 and a bunch of longs getting super rich is not going to make a lick of difference to the to the profits at the end of the day from LPs. Now, if it is if the if it's not balanced, then LPs are directionally exposed as essentially counter traders, and so from that, when traders make profit, so then that would come at the expense of LPs. And so one of the ways to be able to tell historically if that's happened is really to look at the the total realized trading P&L. So you can see here. So since this has been launched, traders, traders. It's no different than like Vegas. Is that the people trading is a zero-sum game, and so anytime that you hear about someone that made a bunch of money trading, that means that somebody lost money trading, or a lot of people lost a little bit of money trading. So usually what you have is a lot of chop ups and then, an occasional windfall. So what we've seen in aggregate since we launched the Atom market, that traders are now down about a little over $66,000. And so what you see that's actually reflected here, that the ratio, the redemption rate of LP or XLP tokens has actually increased about almost 5%. And so this is kind of the inverse of what we were talking about before. And it very easily could happen in the opposite direction. Is that if the delta neutrality was very highly skewed, then and then traders were to make a significant profits, so then we would see this ratio drop below 1. And it's the faster that it happens, the more dangerous it is. But the system is designed essentially to be to be self-balancing. That's why there's the hourly funding rates. That's why there's the delta neutrality fee. That's why there is the adjusted or dynamic borrow fee, so that the likelihood of profiting from the, let's call it, streams of income as an LP, adequately compensate the LP for the risk that they are taking, for the negative, the potential for the negative outcomes, like we just described.
Yeah, makes sense. Going back to what you alluded to at the beginning of the show, you said that Levana started off on a chain that has since collapsed, Terra, right? Is it true that Levana was originally using UST as collateral
Yes.
for
Uh,
okay,
so
and
we
that's why you went against designing it with stablecoin collateral?
Yeah, we didn't want to use USDC.
Why is
Just
that?
because it's not, it's a banker coin. It's very
Sure.
successful, and we all use it. A lot of people run their business off of it. But if you kind of want to ask yourself, is like, could we actually build something that can be, that has the possibility of being owned by a community, that has the
Mm,
possibility of running autonomously or independently, to build something that is, it has a chokehold, within the existing financial system, um, I think is not ambitious enough. And so I think it was rather ambitious for the Levana architects, to try and create something that didn't need stable coins. And I think that it was, I mean, I'm glad it worked, or at least it's worked so far. We've
mm.
only been hasn't been 2 months yet, but I'm pretty bullish.
Okay, yeah, that makes sense. So, going switching topics now to talk about the Levana token, if there is going to be one. The front end says that, if you're basically going to be farming the token based on usage. I think that was implied.
Yep,
Can you talk
absolutely.
about that?
Sure. So, it's very hard to it's very hard to successfully distribute a broad ownership of tokens to vested participants. The current airdrop methodology creates this kind of like rotator culture, where you almost have like airdrop as a service. I think we saw this with Say. I've definitely felt this with other networks, where you can't really get your token in the hands of people that actually care about your product. And so while Levana will have an airdrop. We've got 10 million tokens, which are earmarked for we built 8 um, play to earn NFT games on Terra. So all the owners of those NFTs are going to be eligible for an airdrop. We've had a bunch of missions on Say. Those people will be once we verify who's to the best of our ability, who's human or who's a bot. But there will be tokens set aside for them as well. But ultimately, we want the owners of the governance token. In order for it to be a governance token, there needs to be people that actually care about the product that own it. And so the best way to do that is to distribute it to the actual people that use the product. And it is like a lot of projects have kind of like wink, wink, nudge, nudge, things like that. But I think it is being more direct is probably a better approach. It's I don't believe it has been decided exactly what's the time period of distribution of farming rewards, or the genesis pool of farming rewards. But as we get closer to a token launch, which hopefully will be before the end of this year, there will be publications and infographics and various things that will really outline exactly how that's going to work.
Has it been decided about how the supply breakdown is going to look outside of the 10 millions that's going to be airdropped?
Sure. So the the investors own, I think, about around 35% of the tokens. If I'm not mistaken, I'd have to double check that. Uh, and then um, the team has 20%. Then there is I think the foundation might have. I'll have to double check, but I think it's like 6%. And then then there's I believe it's either 20 or 30%. I've lost track of the numbers here, for the community pool, which will include airdrops and the and farming rewards. The farming rewards are intended to last, for years. So the year one, I believe it's about 7 or 8% of the tokens are scheduled to be distributed as farming rewards, one way or another, over the first 12 months. But I think all of this is, subject to change until it's actually published. I know that there's drafts, and the drafts have been through a lot of different versions. And I'd be happy to send you a copy of it if you want to take a look and share your feedback. It's kind of a long, boring document, but you might enjoy it.
Yeah, certainly. And because it's running on other layer ones, there's not going to be staking as a utility. It's a pure governance token.
Well, there will be staking into governance. It's a similar method. You always want to,
I
uh,
see.
you want to prevent the double voting problem,
Right.
where I could, and where
So it's a
somebody
stake
might,
weighted voting.
yeah,
Yeah.
exactly. It's a stake weighted voting.
Yeah. However, it's not going to be used to stake as security, like as as collateral to secure
At
any
least
proof of stake.
not in this stage. You can always spin up. That's the beauty of Cosmos, is that if you get big enough to justify running your own Rails, so then you can migrate to become your own app chain. Personally, I'm not very bullish on the app chain thesis from an entrepreneurial perspective. I believe that the cost and overhead of running your own app chain and securing your own app chain, whether it is through you're just directly through your own token, or even even just subsidizing like mesh security, or other forms that are the Cosmos de jure chain securing methods.
Hmm.
But I think that most projects end up using way too many resources to an infrastructure level, which doesn't necessarily help acquire product market fit, and that's something that has negatively impacted the Cosmos space, over the past couple of years.
Yeah, and fair enough. That's a fair assessment. Just to add to your mesh security piece, the the eureka moment was in realizing, and this is Sunny's realization, that any any coin or token with any amount of value behind it can be used as collateral, slashable collateral for a state, for to lend itself to the security of any proof of stake chain. So
Absolutely. Yep.
yeah, once we have the ability to import basically any chain's token to use as collateral, then there you go. Then that circumvents the bootstrapping problem that most app chains have.
That it is true, but it doesn't. It doesn't. One of the other positive flywheel elements of the delegated proof of stake is that as rewards increase, then velocity, as real yield increases, assuming that the real yield is distributed to validators, or delegators to validators. So then you end up with a decrease in velocity, and if you just like the basic principles of exchange rates between currencies, like with an M1 currencies, that when velocity decreases, so then exchange rate increases, so like meaning like it pumps bags, so to speak. You do lose that positive flywheel, that essentially the fact that if I'm on, the more money, the more fees that Kajira is taking in, the more people that want to own a larger portion of the Kajira network and then stake to Kajira validators and then earn whatever fees that that Orca or these other apps that are on the Kajira chain are collecting fees from. So it's this positive impact that the chain actually, the cost of attacking the chain goes up, directly related to how successful the chain is, which then in turn allows for the chain to secure a larger TVL, which then allows it to collect larger fees. And so you have this just continuously positive feedback loop. So I think that while you're right that the mesh security does drastically reduce the initial costs of bootstrapping a network, it does lose a little bit of that positive flywheel of direct correlation between security and success.
Mm-hmm. Yeah. I mean, you hit on another utility of a coin, right? The coin is the the conduit by which a community could collect itself over and create some kind of cultural meaning behind it, just like ETH or Bitcoin.
Yep.
So right, in as far as any token could be used for security, that's fine. You could use it as such, but beyond that, you still need to have a cultural element that gives meaning behind a token project.
Yeah, I think, yeah, it definitely is. It creates fanboys, and it becomes a rallying point. It when everybody knows the price that they first got into Bitcoin, and and everybody knows when you're in the money or not. And so I think that the social impact of the correlation between the success of a project and the success of its token is not something that should be readily dismissed.
Yeah, fair enough. And so, if you were to predict what's going to happen in the future once we have mesh security, would you imagine that the sequencing of like mainnet deployment would look something like, oh, we bootstrap with mesh security with other chains tokens first, and then as we gain traction, we slowly uh, wean out the original tokens, and then we replace it with our own native token that the
I,
community could.
I think so. That's, I think I actually just had a call today with somebody on Eigenlayer, and kind of discussing this exact point, is that if you're bootstrapping, kind of, if what Eigenlayers, if I'm this is the first time, and I've never actually read their white paper, so I'm saying this secondhand, so I apologize if this is full of inaccuracy, but it will allow you to essentially spin up something very similar to an app chain, but as a layer 2 on Ethereum, I believe as a fork of Optimism, and you will be initially securing it through liquid stake derivatives through Lido of the ETH token of ETH. So
Mm,
um, so so my pushback there was, that you lose a lot of the these the real world benefits and correlation between the success of a project and success of a token, when the security is completely disconnected from the actual asset itself, or governance asset itself.
yeah, exactly.
And so, but I believe that there's, the response the pushback that I got from this particular VC that was, walking me through it, was that there's this, the ability to have a transitionary period, which was exactly how you described it. That, you might bootstrap it with ETH or with Atom or with some other token, and then you're able to do, dual rewards, and then, even potentially just completely transition over to an independent or self-contained reward structure, based on your own, native token of that chain.
Well, okay, I actually, it's interesting synchronicity because I was having a similar call about just that. We were looking for something that gives you Cosmos SDK like staking and governance capabilities, but using Ethereum as the settlement layer just because the network effects are there. However, the problem we run into is the fact that if it's an Optimism fork, you have one centralized sequencer and you basically trade off the decentralization effects, and you don't get the benefits of having a native token on the SDK layer 2 rollup for staking. And it just gets relegated to a signaling token instead of actually using it for security.
Absolutely. I think the single sequencing is the biggest choke point, because it completely removes all censorship resistance, from the application, and that there's it's almost like you've gone into the realm of theater. Not to say that
Completely.
the Optimism team has done a lot of really great work, but unless blocks are being packaged by independent lottery winners one way or another, it's, I mean, we're kind of, you're kind of just whatever. It's just
Yeah.
whatever.
Yeah, and it's so early too because as you and I have discovered that there is demand for something like this, right? And maybe it takes some kind of middle abstraction layer like Espresso to help with decentralizing the sequencer. But then it's just adding layer on top of layer for for
Yeah,
something.
it,
Yeah,
it feels like you're. It feels like a yeah. It feels like you're bandaging a broken, like a foundationally broken system. But you had mentioned about the the wanting the network effect of Ethereum, and I was actually chatting with the Kepler guys earlier today about this, um, and I think I did a very poor job expressing myself. Sometimes I lose a lot of nuance just in terms of what, in text, and so if just as a heads up, if I piss you off when we're chatting with each other, it's nothing.
that might be a general. That's like a
No,
truth.
yeah, exactly. But so what I was explaining is like the biggest friction to to Cosmos is really Kepler. And it's not that Kepler's a bad product. Kepler's a great product. I think Kepler's better than MetaMask, from many respects. But the fact that there's 30 million people that have MetaMask creates a really sticky ecosystem. And that's why we see things like Base take off and Optimism take off and Avalanche and all of these other things take off. It's why we see Near, abandon their own their own the Aurora zone, and no, Aurora was the EVM compatible one. I forget what the other one was called. It's just, it's why we see kind of like we're in a consolidation phase of crypto, where people want less tooling, they want less touch points, and they want to learn things less frequently. It's almost like, when was the last time you downloaded a new app on your phone? We've kind of gotten to like the app fatigue mode, where every time that you've downloaded an app, the cost emotionally of downloading a new app is higher. So every wallet that you've downloaded, every bridge that you've gone through, it requires more friction. And I went through this usability study with like a sample size of about 30 people, and I was very unsuccessful at getting people to install. I wasn't even trying Kepler, which they've heard of. I was trying Compass, which is the native wallet for Say, produced by the Leap team. And it's really challenging to get somebody that is doing anything at scale to be willing to download a new wallet and then bridge into a new ecosystem, just because there's enough opportunities really within their their I don't know how to say it. There's a phrase in Hebrew, it's called Dalet Amot, but within their little box. So we've all got our little box that's kind of set up right now, and people don't want to get out of that box. So I would push back to your previous statement and say that the moat isn't really around Ethereum. The moat is really around MetaMask.
Yeah, yes, right, sure. Around the EVM, around MetaMask, and that kind of composability where all roads basically lead to there through um, this one central train station, let's say.
Yeah.
But given, I completely agree with what you said, and it made me think about what Elon is doing with X. It could just be that he turns it on one day and boom, X can take the entire market share of MetaMask and Kepler and everything if he built a wallet for crypto just started building out crypto infrastructure.
I've seen those mock-ups.
It's like the same thing.
Yeah, I've seen those mock-ups. I've read the terms of service. I think a self-custody seedless crypto wallet is coming to mainstream. And forget about Elon, Apple. Like it once Apple, just every iPhone just
Sure.
comes with
Yeah.
with an Ethereum wallet. It's like, I mean, it's game over for any other wallet
Hmm.
producer,
Yeah.
really. So I think like
Right.
I have like an existential, crisis here of thinking like, is Levana just kidding itself by not supporting MetaMask? And what does that look like? Where does Snaps fit into this? Where does, it's not really, we don't really have to abandon Cosmos. We just need to be friends with the rest of the ecosystem of like the world.
Yes. Yeah. Completely agreed. Um, right. Right. That's certainly a more infrastructure question, more composable infrastructure question. Um, and if it's any crypto project, it's going that should be taking the lead for interoperability. It's us, right? So okay, well, yeah, we're coming up on time. Let's end this. I'm sure you have another call that you have to
I
go
do.
to.
I'm secretly texting them out of the corner of my eye here.
Yeah.
Yeah.
Yeah, pick that. All right. Let's end this here. Thank you, Jonathan, for coming on for a brilliant second episode. This is definitely a 401, not the 101 class like we had in the primer episode. So be sure to check that out if you haven't already. If you're going to be in Stanford next week, say hi to me. I will be there as well, and we'll be playing some episodes that I recorded at Modular Summits for Sovereign Radio. So be sure to check that out. All right, Jonathan, great to have you again.
It was
And
a pleasure. And I'll see you in Istanbul.